This conference will now be recorded.
Welcome everybody to our last quarterly update for this year of 2021. The topic today is the global recovery and is it peaking? And I'll go through a fair bit of information on this presentation, really just covering off on what happened leading up to the events of where we are today. But also I'd like to give a bit of an insight to how I see the rest of the year playing out and into 2022. Of course, all the information is generic in nature, and if you have any questions, please seek your advisor's advice and make sure it's appropriate for your own circumstances. So let's kick off. If I look at what happened in COVID, the governments around the world decided to stimulate the economies due to the fact they thought we're going into depression. That meant that they would lock down, they pumped a lot of money into the system. People found bank accounts were swollen and they were biting at the bit to buy something. We saw the take up of pay online services do really, really well in that period. And we saw other sectors like restaurants, airlines, and cafes, etc., all decline very, very quickly. Rolling forward today, this has all been reversed. And what we've seen now is governments are opening up. We're starting to see demand really increase. We're getting people, especially in Europe and America, about going back to their normal lives or as near normal as possible. What that's done, though, is caused a huge demand spike from the developed worlds where vaccine rollouts have been very successful and have caused consumers to really embrace the consumption side. And we've seen pressures start to build in the system. Now, some of those pressures are coming from supply chains. And if you've been waiting for a car or something new from overseas, you know it's taking a fair while. And we're seeing, because of these supply strains that come through and the demand, that pricing is starting to rise. And part of that pricing is now being felt into the inflationary cycle that we're moving into. When I look at the world, most of us are in what we class as the mid-cycle. So this cycle is historically can be quite long. It just becomes quite volatile as things start to normalize. For example, interest rates look like they should start to rise. We start to see mortgage rates move up a little bit. We start to see even wages starting to increase in this sort of environment. The good news is that it's really about normalizing again. So I expect that we will see a further tightening in the global economy as we start to see world demand really pick up, especially from emerging markets as they roll out their vaccines as well. One of the downsides, I guess, of what we're seeing is that China, who accelerated out of the crisis faster, is going back into a recessionary phase. Now, that will have some impact to the global output and global growth, but not a lot to derail it for this year. I think going into the new year, we may see some pressures from China's slowdown. Going forward, one of the things we will see is the increase in market volatility, and there's three reasons for this. We've got the election here in South Australia, in Australia coming up. We've got elections in the US coming up. We also have the central banks pulling away money that was very cheap for the banking system, and that's going to have rising costs. We're also going to see inflationary pressures push through. And we're seeing that already come through in food and also in energy prices, but also in basic commodities. What we will see is that money will probably get tighter, and the money that's in the share market that would not normally be there may start to drift back into cash, away from the share market. So I think we'll start to see more volatility in shares as we go forward from into the 2022. When I look at the asset performing for this quarter, they've been quite range bound as we're trying to digest this uncertainty. And, you know, the first talk of inflation, we saw markets pull back quite quickly a few months ago. And since then, especially in Australia, we've gone to sideways. We haven't retested that peak. I think we will, but not go much higher than that for the rest of this year. I would expect to see commodities that are inflationary hedges, such as inflation-linked bonds and gold, will start to pick up into the new year. And I expect that heavy or large cap stocks will probably outperform mid cap stocks and your small cap investments. So it's been a challenging quarter because we're trying to digest what does tapering mean. What does the outcome for interest rates? What's going to happen with the property market? There's lots of things to try to digest, and that adds to the volatility that I would expect to see come through the markets into the new year. When we look at market corrections, this is not a crash coming, it's a correction. And I expect the drawdowns will be between 10 and 20%, 10% for Australia and probably up to 20% in America. Predominantly because they have a large amount of high growth companies, and the interest rates rise, their cost of money rises quite accelerates quite fast, and therefore their profits get squeezed harder. Now the good news is the average drawdown takes about 5 months. The correction we could end up with 2 or 3 in this mid-phase cycle. Over this, because the mid phase can stay in this level for around 4 years. So it depends on what the governments do and how quickly they raise interest rates to move us into the mid phase to the late phase. But the good news is these are only corrections, and normally the markets do rebound, not necessarily go to new highs, but they sit in a trailing range over this period. But we do see a rotation into more defensive style areas, and they are like your Woolies and your Coles become quite defensive. Your food stocks do quite well as well. So groups like Eames Chickens and Kentucky Fried, Costa Group, but also your Kentucky Fried and Domino Pizzas normally do quite well in a mid-cycle as well. When we look at what's driving this is that as we pare back the liquidity and the governments refrain from buying bonds, the open markets start to work again. And we start to see interest rates move back up. And the 10-year bond rate is probably the key for us in this part of the cycle. We don't worry about bonds until they get over that 2 to 2.5% level. So currently in Australia, we're sitting around about 1.6 to 1.8. In the US, about 1.6 at the moment. So so that tells me that government's borrowings are starting to rise as well. So it's not just the individual, but government's cost of money starts to move up at the same time. So all this adds to pressure, and as the markets need to digest this. Now, in a outlook, I would expect companies with great balance sheets, so very low debt. Companies that have a market dominance will do very well. They can pass those prices on. Some of the sectors that are market takers or price takers, where there's lots of competition, they won't do so well. And so this is probably what you'll see happen in the redesign of the portfolios every quarter, is that we'll start putting more of those bigger names in, hence large cap stocks that are market dominance, market powers to actually increase prices going forward. If we look at the macro and how we see the world's really gone from being in a recovery phase into the mid phase. And you can see the US here on this chart is actually starting to roll over and coming into the late phase. China's ahead of everybody. She's actually probably closer to recession. And some of the signs we're seeing with the Evergrande property cycle and other large developers coming under stress, we start to see the Chinese government start to introduce more liquidity to stop defaults. And I expect that the Chinese, through its own banking system, will support these large developers as well, because the last thing they want to do is see these companies fall over and take the consumer's money with them. If I look at Australia, we've done really well. We're still coming to the peak of the cycle, but as the peak suggests that growth is peaking, credit growth is strong, but the government's trying to tighten this, and we're seeing now in our mortgage belt how APRA is stepped in and started to raise the assessment or the cost of money in the assessment to see who qualifies for a loan. So we're having a pseudo rate rise in Australia. We're using the regulator to make it harder to get a loan as if we were starting to raise rates. If I look at the Japan and Korea, they're really starting to move on as well, and they'll catch up to us this quarter, I'm pretty sure of it. Brazil, India, and Mexico, they're lagging. And the real reason they're lagging is because the vaccine rollout's been very slow. And poor countries don't have the same systems in place to vaccinate people. For example, in Brazil and India and Mexico, a lot of people aren't registered, so that they don't know where they are, they don't know where they live, and so very hard to get hold of them and inform them about COVID and what they should be doing. So they're going to take a while to recover. Also, the downside for especially Brazil and Mexico is a lot of their debt they've incurred is in US dollars. And at the moment, if we're going into a tightening cycle, the US dollar will rise, and that will put more pressure on those economies. So that keeps them pretty anchored, and they may miss this whole cycle that we've seen in this recovery. If I look at the manufacturing side, it's strong, but we've reached the peak in industrial activity. And you can see very clearly here how emerging markets have now gone back to baseline, so they're no longer expanding. But you're also seeing the globe as a whole started to weaken as well. And so I think part of this is that we're seeing a resurgence in COVID, but the other part really is the fact that we've got this bottleneck in ports, we've got the lack of supply coming through, and all these add more challenges. And so we see that utilization rates in factories are actually falling and not increasing because they can't get the inventories that they need. So it's actually a supply issue that is causing the world to slow down. Demand's strong, and so hence the inflationary pressures that's coming from it. When I look at the China cycle, they went through a very quick tightening. They got rid of the shadow banking, and we saw a very sharp drop with the shadow banking and the tightening of liquidity that came through in housing sales. You can see they collapsed on this side. Also, land acquisitions fell away at the same time. So this is where the pressures come in for groups like Evergrande. Now, a lot of people think this is a Lehman Brothers moment for China. It's not. People fail to realize that the Chinese government, state-owned entities that are owed this money will get the backing from the Chinese government. So they won't allow these companies to officially fall over and wipe out the wealth of individual investors. They will get the shareholders will lose money, the bondholders will lose money, but the individuals won't. And I expect that the government behind the scenes is propping these large groups like Evergrande up so that it's an orderly deflation or exit out of the system. And even down to the extent that the governments will start to buy some of the assets if they can't be sold. So large land banks, etc. With the credit, I'm expecting that the credit will start to ease, that the government, where they've put all these restrictions in place, will start to ease the credit cycle, and that will actually encourage more growth to come through. It won't be all holes barred and go back into property. I think they will actually focus more on consumption and try to get the money deeper through the economy. So the rebound will be slower, but it will be good for Australia. It will support iron ore prices again, and it will support all other base metals. So the cyclical cycle of the stocks, I think, will have another leg. It won't be as quick and sharp as what we saw post-COVID. Gradual increase as liquidity will be released quite slowly this time. When we see this savings rate around the world, and Australia's the same, we've seen that households have used their excess savings to actually pay off debt, and that's great. It means that they've got more money to spend later on in consumption, but also debt servicing has come off as well. So we've seen the opposite side for new home buyers go into the market and bid up prices to record highs. And in Australia, we're seeing 20-21% price increases. This is not because our wages have gone up so much, it's the fact that interest rates are so low. So one of the issues we do have is that going forward, if rates were to move too quickly, that could actually take away some of the wealth effect that we're seeing. Now, a lot of the price increase that we've seen has really come from the lack of supply of old homes and new homes coming onto the market. So I think that supply issue will be caught up over the next couple of years. But for this year and into next year, I think housing globally will continue to be quite strong. When we look at then the results for corporates, then there's a few more headwinds. And the reason for this is that, we've seen strong nominal GDP growth globally, and we've got a healthy consumer, but sentiment's changing. We're starting to see the consumer worry about inflation. They're seeing the cost of petrol rise. They're seeing the food bills rise. They're seeing the price, especially in Europe and America, the cost of heating rising quite quickly. So we are starting to see the consumer take their foot off the pedal. But for corporates, it's a little bit worse. They've got those same overheads, but they've now got labour costs rising, which is quite neat. They've got productivity gains, which have come through from innovation and technology, but wage growth is growing quite fast. Also, the labour shortage is a bit of a problem. And so with that labour shortage, you're finding that companies can't go full steam and increase their productivity on the other side. Input costs are rising, as I said, that's a negative. But till interest rates rise, then the cost of servicing debt is still quite low. But that will change in 2022, and I expect that we'll see some earnings revised lower. The chart on the right-hand side actually shows this. This year, we're looking for earnings expectation around the 45% level. Now we're looking at growth around about 9%. So going into 2022. So there will be some recalibration in the share market. When it comes to the labour market, this chart here shows exactly what's going on. In July, there's 8% more job openings than people to fill them at the moment. And there's a couple of reasons for this, especially in the US, is that older workers aren't returning back to work, but also it's the education gap that's come through. The migrants filled a lot of the low educated jobs, so such as customer service, might have been bus drivers, might have been train drivers, etc. So they filled those gaps. That's not happening anymore until we open up our borders. So the job openings, and we're seeing this in Australia, where there's a shortage of attendant staff, especially for restaurants at this stage, chefs, front of house, etc. In the age group, there's also a large pool of people who decided to take early retirement because they're worried about the pandemic, and they're not coming back to the workforce. So the pandemic actually had people revisit the way they were living and decided that they wanted to retire. So I expect that this, until we open the borders, the wage pressures will continue to grow, and that will be quite structural in the form of inflation. And I expect that, unfortunately, it will be an input cost that will continue to surge into 2023. When I look at the Americans, and they're probably leading the charge in this because they opened up a lot stronger and quicker than us, and you can see on this chart very clearly that not able to fill positions, it's getting up to around 40% at the moment, and to compensate, they're increasing wages at the same time. So, and I expect we'll see this in Australia as well. It's global. It's not only here in Europe. They've got a shortness of truck drivers at the moment, and that's putting constraints on Christmas deliveries, etc. And you've seen the warnings come out about ordering your Christmas present early because of these constraints that we're seeing. When we look at the supply side and the fact that we don't have a lot of orders being or inventory to actually sell, we're seeing back orders rally quite high. And so this is causing that inflation demand coming through. And that's now feeding through that most people believe we're moving into a period of high inflation compared to what we were last year. People thought inflation might peak around 2%. We're now talking 2.5%. So that's quite a lot. And considering that's sitting at the top end of most central banks' targets, they all want inflation to help with eroding the debt that they've taken on board. But I think this is probably going to be revised up as we move into 2023. And because I don't see the supply side pressures disappearing, I don't see the dropping in shipping rates dropping too quickly, and the fact that inventories will have to be built up again to help with the backlog of orders. So I think it's going to keep inflation elevated for some time. While this is going on, we're seeing that central banks have said, well, the life support's now coming off. And as we roll into 2022, we'll see governments around the world reduce their bond purchasing, which will allow interest rates to move up. So we have a situation where there's a lack of supply, a lot of demand. Money has been very cheap and has been flowing into the system. Some of that money is being pulled back, and that will start to give interest rates a tickle upwards. Also, it's not only the consumer that will benefit as far as deposits, but also we'll see governments actually will have to pay more for their money as well. So I think the liquidity is peaked and now is going to fall back, which means that some of the money that's been pumped into the share market will come back out of it. Money's been pumped into Bitcoin, will come out of that as well, and out of collectibles. So we should start to see some slowdown in activity, and the fact that markets will recalibrate to the lower expectations. When I look at how government's going to fund all the liability they've taken on, we're going to see tax changes coming through. US has already talked about a new tax, and we see that the Tesla group are out there on Twitter talking to the government about their new wealth tax, saying it's unfair. I expect we'll see governments look at the ultra wealthy and look at the ways of reducing their tax liabilities in the future. So the deficits are actually going to come off quite quickly. We see here in the US on the left-hand side that the deficit was nearly 16% of GDP. With the new wealth tax and business growing, you've got more employees, wages increasing, more income tax. You can see that deficit will reduce quite quickly to around about 9% of GDP. That's a massive turnaround within 12 months. So, the good news is that the economy will better fund this because we are going to have more people employed. The effect of one of the things that Donald Trump brought in the US especially was that he reduced corporate tax. Biden's government's going to raise that again, bring it back to the normal level. And I expect our government will do similar. We'll start to see the government introduce new tax measures. What they're going to do to compensate for the higher tax is they're going to start spending on non-shovel ready projects. So we're going to see a lot more money going to manufacturing, a lot more money going to infrastructure from governments, and that will give a trickle-down effect to the economy and keep the economy moving forward. So as I said earlier, the mid-cycle can stay intact for at least 4 years. It doesn't have to reach its peak and then roll over. It can be a slow decline as the government steps in with these long-term projects. So as we're in mid-cycle, in the business cycle, I expect that we will see more volatility. We are going to see interest rates rise probably quicker than what the market's anticipating, and hence the volatility. I think it's still appropriate to be overweight riskier assets at the moment, but just start to look to diverge into more uh, larger companies away from smaller companies. Look at investments that are inflation tolerant, such as gold and inflation-linked bonds. Stick to markets that are reasonably valued, such as Australia, Japan, and parts of Europe. I suspect that with China slowing for Australia, we will get the uptick as China stimulates her economy. So we're in a better position than what Europe and America are, because our largest trading partner is already ahead of them as far as the recessionary phase they've been through. So what does it mean for assets and what we're going to see? If I look at the total growth that we've seen in the world has been phenomenal. Year to date, large cap stocks in the US have done nearly 16%. We've seen emerging markets in Europe especially have done around 20%, but commodities have done really well. They're up around 29% year on year. Gold, not so much. It's come off about 7% over the same period. But I expect that we'll see and since this was done, we've seen iron ore prices fall back quite substantially. We're starting to see the oil price stabilise at the moment around the $84 a barrel. But I do expect to see another leg as inflation bites. We'll see those commodities move higher. So if we look at the earnings of shares, they've been pretty strong, and you can see we actually did pretty well with all the rebound that's come through, and the earnings growth rate at the highest it's been since 2017. So we've globally, the forecast has been quite good. Now we've actually met those, and I expect that some of the earning forecasts will be revised backwards or down as we move into 2022 to 23. Now, the good news is emerging markets are already cheap. Developed markets are below their long-term average, which is good. The only market that is still quite elevated is the US. So I would expect the US will be a lot more volatile than us and a lot more volatile than some of the emerging markets as they really calibrate. And I expect that we'll see the US dollar strengthen in the short term due to the fact that the Fed Reserve will raise interest rates faster than what the market was anticipating. So where do we go for inflation proofing our portfolios? Well, energy companies do very well. In fact, the higher the energy prices go, the higher the inflation rate goes. And we're seeing Biden's government being pressured to release their strategic reserves at the moment of oil to try to drive the oil price down. But industrial metals are still pretty strong. Nickel, for argument's sake, is still sitting around that $18,000 a tonne mark. Gold is still quite elevated, but overall we're seeing now food commodities move up as well. So the shopping basket is getting a bit more expensive. Tips do well in this market, so they're your inflation-linked government bonds. Where we see the negatives in US tech stocks, they start to suffer a fair bit. The US equities, which are really skewed towards technology, they will suffer more on that side. So it's beautiful Australia. We're in a bit of a box seat. We'll get this lift as inflation comes through. Housing normally does very well initially until interest rates go up too many times. And it normally takes 3 rate rises to actually turn housing over. When we look at the mid-cycle where we sit today, we can see the market move from growth to value stocks. Now the market's moving to service sector stocks, and especially in the US, we can see both now are even. So there's a little bit more upside, as I said, but really now the market is getting to the stage where it's fully priced, and the value stocks are no longer discounted. I think the good news is that the merger and acquisition that we're going through is still very elevated. And we're seeing in Australia a lot more activity here with property trusts now merging. We've seen our utility sector being under takeover through groups like APA. We're going for Spark Infrastructure. We're seeing a lot more mergers in the healthcare, in aged care sector as well. So I expect that we'll see this activity continue, and it's global. Everyone's doing it at the moment. We are starting to see some of the activity turn to the negative side where they can't raise capital, so it's script for script, which is normally a sign we're near the peak of that cycle as well. So as we move into the late or mid-cycle, the average growth rate for the share market sits around 3%, and the income is what drives the rest of the performance. So I still expect the market to give us a return around 5-6% going into next year, but that's about it. I think overall the earnings will be, or the performance will be quite flat. So if we're in the mid-cycle economically, the share market is already buying into the late cycle. So materials, it goes from being a strong part, it's selected materials. And I think especially with the advent of EV and ESG coming through, that, metals like copper and nickel and cobalt will still have huge demand, and aluminium as we come through. But we start to be overweight food stocks, staples, energy stocks do very well, utilities do very well at the same time. Now, as we move past this cycle, we'll start looking at going to consumer staples, healthcare, and overweight utilities will be where we focus. Unfortunately for the investor, his cash rates are very low, and it's going to be very hard to convince them to put their money into cash, and they'll think they need to be fully invested. But as you can see, there's not a lot of areas to invest in. The rest of the areas are really suffer as interest rates rise. So these three areas that got the double pluses in them, consumer staples, our healthcare, and our utilities are the safer sectors to be overweight in as we go into the late phase. So the long-term risks, look, I think we're going to sober up that the inflation and growth mix don't go that easily together. But and I think the inflation is going to last longer and linger around more than what the central banks realise at this stage. So the good news is, though, that China is coming out of a recession phase, so she will help stabilise some of the activity in the share markets and in the economics side of global GDP. So if I look at economic activity, it's in the green now. It's not strong. It's still climbing, but I don't think we'll get to completely strong. Inflation, I think that will rally ahead of economic activity. And so we could end up a world where the economic growth is quite slow, but inflation is quite high. And people talk about stagflation. I'm not sure we'll hit stagflation as such, but it's something we need to watch. Monetary policy will have to continue to tighten and move more to a neutral balance as we go forward. So I think in the short term, this will cause the US dollar to strengthen, which will take some of their inflation hedge away from them. But other countries may find they're importing inflation, and that will cause their central banks to start looking at raising interest rates faster as well. So what about Australia? And, life is set to return to normal, whatever normal is going to be after COVID. And I think what we're starting to see is that, locking down doesn't work. We've found that the economy, especially in Melbourne and Sydney, they got hit very, very hard. And we're very close to going into another negative quarter like we did when COVID hit, but we managed to come out with a positive. The good news is that our economy this time shrank a lot less than what we saw overseas. So that's a positive when we compare to other OECD countries. So the government's done a good job of keeping us moving. State governments, on the other hand, are causing issues. And as you know, the government wants to open up, but every state is using these powers they've got to actually peddle their own agendas. One of the issues a lot of people ask me, they say, well, what's going to happen with all this debt? And it's one of those things that if interest rates stay low, the debt's not an issue. Our debt to GDP is sitting around 40%. It's not exacerbating in any form at all. It may grow to 50% of GDP. You know, around 70 is when we start to worry. So at 50, it's very manageable. If we get the economy moving and we open up quickly, our best case is that we can reduce the debt back to zero by 2060. Our worst case is that we'll still have debt right into 2060, 61. The good news is that the repayments, if we did find ourselves in this situation, is the cost of money wouldn't probably go over 2.5%. So providing we can grow the economy greater than 2.5%, we can service our debt quite easily. So the level of debt's not a real issue, and we shouldn't really worry about it too much. When I look at the areas of working from home, we're going to see the workforce change. And you can see on this chart that in response to the pandemic, before the pandemic, 38% of the people in this area have flexibility to work from home. But basically, it stayed pretty neutral going forward. So the financial services industry hasn't really been affected by COVID too much at all. Where the sectors that get hit hard are your arts, your recreation, your accommodation, food sectors, construction. They can't work from home, which makes sense. But science, technology, they can split evenly. Your admin support can split evenly. Finance can split evenly. So there's certain sectors that can. So I expect that we'll see a lot more flexibility in the workforce going forward. Some of the issues now is, do you get the same pay if you work more from home? I think in some sectors there won't be any difference, but others will probably start to negotiate different pay structures. When I look at the jobless rate that's come through, and it was quite amazing. In the last quarter, we saw unemployment fall to one of the lowest levels, around about the 4.2 level, and that didn't make sense to me. And I think what it was that a lot of people realised it was no use, especially in Sydney, Melbourne, looking for a job. So they didn't get counted as unemployed, hence the figures fell. What we will see going forward is unemployment will continue to lift up a little bit as the Sydney and Melbourne open up more as we move into Christmas. So I just saw the last lot of figures. Unemployment came in at about 5.2, so it rose 1% as more people are now filing out there looking for work. I think the biggest problem we've got is our underemployment. That is sitting up very high, around about 14%, which is a big issue. And I think the underemployment rate needs to come down. And unfortunately, it's really the underemployment is mainly in people without the skill sets that are required going forward. When we look at job vacancies, you can see every state has a lot of job vacancies at the moment. In the accommodation and food, not so much as lockdown, but I expect that will pump up. But as you know, healthcare is very much struggling. We're not getting the migrant nurses in and doctors, etc. So certain sectors are feeling the pinch already. So job vacancies, I expect will continue to increase until we open our borders, and that's going to put pressure on wages. When I look at house prices, then on the other side, we're seeing the investor come back into the market, especially with the Reserve Bank saying that they're not going to raise interest rates until 2024. So people are looking at the things they trust, and which is real estate. And you can see the investor is almost back to the same level we were in 2014. Owner occupiers been massive. They've been able to get money very, very cheaply. And we're starting to see lending criteria, or we were seeing lending criteria ease back off. Also, that with the sharp fall in interest rates, it made it more affordable to pay more for a home. So the unfortunate part is now the average mortgage in Australia is around $750,000. So that's getting up to 10 times someone's salary, which is quite extraordinary. Normally it's around 4 to 5 times. So we've actually doubled the leverage in the housing market. When we look at how high prices can go, well, housing finance is way ahead of house prices at the moment. I don't think house prices are going to jump 60%, but it does bode well for house prices moving forward into the new year, probably at a slower rate than what we have. We've done 20, 21% going forward. But Sydney and Melbourne, that we're seeing the top end starting to ease off a little bit. So I expect the rest of us will probably see a growth rate around 4 or 5% going into the new year. APRA is making it tougher, which is good. So as I mentioned earlier, they're using macroprudential methods of controlling interest rates, and so they're making the stress test a bit harder. So this is an interest rate rise without having an interest rate rise. So if you see on this chart, ANZ for argument's sake, the base rate's 2.72. The old stress test was 5.22. The new stress test will be 5.72. So you're talking interest rates being up 3% higher. They may never reach there, but this will cut out a lot of new home buyers from going into the market and take some of that pressure off. And it may even test the investor at the same time. I expect we'll see further macroprudential controls come through if the property prices keep moving as strong as they are. So this is not the first intervention. I expect to see more intervention come through as we move into next year. So for those looking for a home, it is going to become easier as we move into 2022, 2023. As I said, the reserve is going to taper, and I expect we'll start that in February, March next year. Whereas, quantitative easing's flattened out the yield curve, I expect the yield curve will steepen. So we'll start to see fixed interest rates move up first. So your fixed rate mortgage will be the first to go up, and we're actually seeing some of that happen now. I would expect to see those rates continue to move up, and the variable will be anchored lower. But as we move into 2022 in the late part, I expect to see the variable rates move up as well. When I look at bond yields, how high can debt go? I expect that we'll see interest rates in Australia on our 10-year bonds have a 2+ in front of them. So I'd like to see them around 2 to 2.5%. That will take a lot of heat out of the market, especially in speculation, in mortgage funds and in high risk corporate debt. We've got a lot of fund managers that are investing in what we class junk bonds or junk debt. This will start to sort them out. They'll move back into better quality, and we're starting to see some of these better quality interest rates start to move up. Not a lot at this stage, but I think these are still safe places to be. But new paper that comes out will be a lot more attractive and really have a risk premium attached to it. At the moment, a lot of paper that's being released from companies is really too opportunistic. They're not, investors aren't getting rewarded for the risk, and therefore they're at a greater risk of loss of money when interest rates rise. So corporate debt, I'm still comfortable with. As you can see, as bond yields move up a lot faster, the corporate debt doesn't tend to, especially in the good quality paper out there. So I'm not saying run for the shelters, just be careful, look for the quality, and keep away from companies that are paying very high interest rates without really having a good risk premium for what you're taking on. And there's a lot of fund managers that are saying they're paying 4 to 5% on their in their fund, up to 6. but they've got a lot of rubbish sitting on their balance sheet. So keep away from those style of funds. When we look at the inflation cycle, it's funny, the consumer is very much aware of inflation rising. The Reserve banks are still talking it down on the other side. They think inflation is transitory. I don't. I think it's more structural. The fact that wages are rising make it structural coming through. And again, a little bit of inflation is good. Everybody wants a bit. So I think, the government wants it to help reduce their future liability and inflate the debt out. But it will come at a cost. It will be a higher cost of money, which means government services or taxes will be adjusted. The cash rate projection is to keep it going through to 2024. I think that will start to change as you move into 2022. I expect that the projection will be that this rate will start to move up a lot sooner. And I wouldn't surprise to see the 2 rate rises in 2023. One of the issues in Australia that we've got to face is our productivity. That the incentive to invest for corporates have been quite low, and so we've actually fallen behind the world in productivity going forward. Now, falling productivity means you don't get wage growth, that sustainable wage growth coming through, and also detract from GDP growth over time, as the chart on our right-hand side shows. So I think this is a good time for the government to actually invest in productivity and increase our living standards, and our living standards, I should say. And I expect that we'll see a lot more of innovation being driven. Now, some of the sectors I think that we'll see a lot more innovation are going to be in the digital sector. I won't go through this matrix. You can take your time and look at it. But data utilization, the risk management with cybersecurity, those sort of things, I think we'll see a lot more investment. Energy, we're seeing a lot about going into the electric vehicle evolution, but also in decarbonisation. And you now got green hydrogen and blue hydrogen, you've got carbon storage. All these things are going to be all new technologies that will really take off, and government will invest in, and this will help with our productivity. Food and agriculture, I think we're going to look at how we clean that up as well. Methane gas is one of the sectors that causes great concern, but also we're going to look at genetic modifying crops to get better harvesting, especially with climate change. We're seeing a lot more disruption in global supply of food through floods and droughts that's come through. So I expect that we'll see a lot more innovation in that sector. Aging population, we always see a lot of innovation in health, and I continue to see that expanding, a lot more government funding in that sector. But also manufacturing. What's COVID taught us is that we've got to bring some of the manufacturing back home, especially essential manufacturing. And I expect that the government will spend a lot more money improving the productivity on this part of the cycle. And then you've got our mineral resources. I think the fact that we are moving to more of an ESG focus, that we'll see great demand for nickel, for cobalt, for aluminium, copper, etc. And so we'll be seeing a lot more deep sea ports. We'll see a lot more robotics being used in this sector to make things more productive going forward. So it's not doom and gloom at all. I think the good news is with every recession or deep recession, we come out stronger. And these 6 areas where I think the governments will focus a lot of this stimulus. Just to show you what it's like in the just in the EV side or electric vehicle side, you can see the positive loop that comes out, that comes through. You reduce the cost of renewable energy. You get competitive, sustainable products coming through, and you keep the demand of energy moving forward. And we're seeing this now with the uptake of wind, concentrated solar. We've got power, battery storage, and now we're talking hydrogen. And you see everyone's moving towards electric vehicles as well. And we're seeing large producers come out saying by 2030 Majority of their cars are going to be electric. So we're moving down this path very, very quickly, which is excellent. And I expect that for Australia, we're in the box seat. Just to show the sort of sector that will go in decarbonisation, it's going to be your wind is going to be increased, solar is going to be increased by about 5 times, and EV is expected to increase by 2025 around about 12% a year. So it's going to be a massive growth curve that comes through. This is going to keep huge demand for our base metals. As I said earlier, it bodes well for our supply chains. It bodes well for demand from Australia, and it bodes well for all our employment in the future. So where does this put us? Well, this puts us in a cycle where we're in the late bull phase of the share market, and we're in the getting to the peak of the economy. The yellow is the economy. So the share market is already looking at these sectors, and our models reflect the sector as well. In my next models in the next quarter, you'll see me concentrate mainly on consumer staples, the healthcare, telcos, and utilities as we go forward. You know, there are going to be some changes. There will be a lot more cash on hold. As I said, I expect the interest rate cycle will steepen. So term deposits will start to show at least a decent sort of return, hopefully with a full figure in front, like 1.2 or 1.3. And could even be high, could be as high as 2%. But I do expect to see interest rates move or term deposits move up. We still have a bit of a crossover. We'll still hold gold for the time being and our inflation-linked bonds, but we'll probably sell those as the year rolls on as well. So in summary, what to watch out for? I think you know, with us rising, getting our vaccination rates up, the roadmap is really that will probably continue to open up the economy. We're not far, you know, completely out the woods as you see in Europe. We need to get the top-up vaccines out, otherwise that will slow our economy down. So we do need to see the government roll out and have the top-up vaccines go through, and we're starting to see that rolled out now. It's going to be how do you convince the population to go for the 3rd jab. I think a sharp lift in the 10-year government bond has started to give us some value back. Again, you're starting to see compensation being paid for inflation on the other side. We're not quite there yet to buy into fixed rates, but it is looking better. I think the RBA is looking for a inflation rate around 2 to 3%. I think we're going to get there, and I expect that you know, will surge through, especially in the new year. The government will be, and the talk will be about the higher inflation rate and the impact on the economy. It won't have upset the market too much initially, but if we start to see rates or the rhetoric of rates rising quicker, that will start to have a negative impact. Why I've moderated my pro-risk stance a little bit, I still think you've got no real choice but to be in riskier assets. Just move to the larger end of the cycle. Look for the assets that pay good dividend to compensate for the volatility we're in and the lower growth rates. So we will stay overweight equities for the short term. The restart gives us advantage into some of the cyclicals, as I said, with the mining boom that will come from ESG and electronic vehicles, but also the reopening with our, you know, our flight centres of the world as well, and some of the restaurants and hotel groups out there. So overall, I think that you know, in the short term, we're really in that that crest of opening up. Longer and we're going to see a lot more volatility, but I expect you will see new technologies come. We'll deploy, and they'll be deployed over the next year or so, and that will have positive impact for the economy. Longer term, I expect, you know, future shocks will be the cost of money moving as we move into 2024. So Yeah, I think it is going to be a volatile ride for the next 2 years, but I don't foresee a crash of any form. I think it's just really us getting back to a near normal. Thank you. If you have any questions from the PowerPoint, please feel free to send them through, and I'll endeavour to answer them for you. Thank you for your attendance, and have a Merry Christmas, and I'll hopefully see you all live in the new year. Bye for now.